welcome to the Monday edition of Dividend Cafe. Rainy day here in New York City, but back from Washington, D.C., and excited to get back into this with you because there's been a lot going on. I dedicated the Friday Dividend Cafe to the 5-year anniversary of the COVID craziness of March 2020. Today is March 24th. Technically, the market bottom was March 23rd, 5 years ago, but because that was a Sunday this year, we'll, use today as the 5-year anniversary of when the market bottomed, getting to the low 18,000s, which is really surreal to think about. That the drop we had 5 years ago over that 2 or 3 week period was so incredibly quick and violent, but that the recovery has been so incredibly profound. The market was up almost 600 points today. It had started the day at 42,000 and ended the day near 42,600. But 5 years ago today, we were talking about flirting with 18,000. So 130% move higher from that bottom level in 5 years. The story of what took place 5 years ago was Friday's Dividend Cafe. If you're listening right now and haven't checked out Fridays, I would encourage you to do so. There's some lessons, kind of 5 key takeaways that I offered from the insanity of what happened 5 years ago. But for our purposes today in the Monday Dividend Cafe, we're mostly just going to kind of go through the here and now. And I want to share a few takeaways from my time at the Treasury Department last week in DC. In terms of today's market action, we opened up about 200 points and then just sort of steadily went higher from there. It kind of sold off a bit from its high levels in the middle of the day, but then came off of that in the last hour and a half of trading. And so the Dow, like I said, closed up just a hair short of 600 points, 1.42%. But the S&P was up 1.76 and the Nasdaq up 2.27. So you had a big risk on rally day, mostly driven by, there were stories yesterday in the Wall Street Journal and Bloomberg that the administration is expected to come in on April 2nd with more targeted tariffs than had been previously believed. And President himself today was sort of talking about certain areas that he might get to later, but they're not doing right away. And so you're going to hear some of my comments in a moment, where I think a lot of the action today is very much in line with what I am seeing and forecasting. And not all of it is bullish, but all of it is susceptible to these up and down swings. I'm going to share more in a moment. Um, the market had been in a 4-week losing streak coming into last week, and it was up 0.5% last week, but was still below the 200-day moving average. I don't know if today's market action took it above its 200-day moving average or not, but the key point being there's a lot of uncertainty. There's big up days, big down days, and still certainly a meaningful move lower from where things had been. An anecdotal comment that I think you can do with what you please. There's this expression called a total um, shareholder yield that I'm not a big fan of the expression, but it is intended to combine the dividend yield, which is very measurable, and the buyback yield, which is, I think, less measurable, into one yield that is intended to measure how much capital is being returned to shareholders as a percentage of the share price. The problem with that is that the buyback yield can't account for the shares that are being bought back merely to replace shares that had been issued in compensation. So there's a bit of a moving target there. But even if you took the gross amount of dollars spent in dividends and share buybacks, combine them together, you still have technology and consumer discretionary total buyback or total shareholder yield of only 2.3%. And over half of that is somewhat, shall we say, unreliable. The sector with the highest total shareholder yield is energy, at a 7.4%. So I continue to believe that capital return to shareholders is best measured via dividends, but nevertheless, even various modestly flawed attempts to measure the impact of capital return via buybacks still speak to a very paltry return of capital to shareholders in uh, consumer discretionary and technology. The 10-year bond yield today closed at 4.34%. You had quite a sell-off in bonds with the yield jumping 8 basis points, close to 9 basis points on the day. The top performing sector was consumer discretionary. It was up over 4% on the day. And then utilities were flat. And so 10 out of 11 sectors were positive. I believe the 10th out of 11 best performing was consumer staples, which was up 66 basis points. So not only were all 10 up, but they were up quite a bit. But utilities facing the downward pressure, probably in line with the sort of bond proxy. There's a chart at dividendcafe.com today that I think is very useful, but I use it to point out a figure of speech, a line, a summary, a maxim, if you will, that I think is very effective. I had forgotten the line, but all bear markets start with a correction. Not all corrections turn into bear markets. And then there's a list of all of these different downticks in the S&P over time, and you can see that a bunch of them got to the 20% plus level on the downside. Let's call it roughly 10 of them, and then there's another 20 or so that didn't. And you can take that as you wish, and it shows where today's correction stands in the relative measure. So it's a good visual chart. I encourage you to look at it, dividendcafe.com. I think an increasingly important question for investors is whether or not the global bias towards US based assets is indeed coming to an end. It has been a very strong trend for a long time, dollar based assets since the financial crisis, more or less. And valuations, earnings growth, multiple expansion, uh, not to mention just sentiment characteristics, have all favored American assets over international assets, particularly European, but also Asian, emerging. Um, China's stock market is crushing the US this year, and Europe's is outperforming in a way that it hasn't seen that kind of a bid for quite some time. Now, is this a pump fake? Is this a paradigmatic shift? There has been a lot of moments on the way where people said, okay, this is the time that now Europe is going to revert to the mean relative to US, and it hasn't happened. And that kind of indication and inability to deliver has taken place quite a bit over the last 15 years. Are global asset allocators now re-Europeanizing their portfolios? If they are, I would suggest the American unwind is not over. But if this premature call is yet just another one here, then we shall see. Okay, contrarianism, excessive bearishness would be just as much a contrarian call as I believe excessive bullishness is. And right now, do we see this sort of absolute, purging of euphoria and ridding of all such optimism, where there are just no dip buyers, and you are really looking at an excessive amount of bearishness that you could argue is a good contrarian call? Uh, no, not everyone is bearish. The everyone is bearish moment is indeed a very contrarian dynamic that I love. But in this case, I don't think you could argue that there's imminent reversal on sentiment alone. There's dip buying all over the place, and we'll see how much of it lasts and where this goes. These things are difficult, but I do not think you see a washout in markets, and so we'll let that play out. Uh, Finally, on markets, the most positive thing I could say as an asset allocator is that asset allocation is performing like asset allocation, that there is a lot of non-correlated asset classes, behaving differently than equities. You do not have a pure risk on, risk off environment. And unlike many moments of the last several years, I've talked about over and over again here in the Dividend Cafe, stocks and bonds are not behaving with a high positive correlation. In fact, they become quite negatively correlated, which is much healthier for asset allocation. And so the strong reverse correlation, I think, is preferred. Bonds have done their job. A day like today, stocks were up a lot, bonds were down. We've had mostly days like that, a lot of them in the opposite direction of each respective asset class. My point being that that is really why people asset allocate, to not have everything correlated together on one side of the boat. And that has been a worthwhile, healthy dynamic in this recent market, stock market sell off. So when I talk about my time in DC last week, understand there are some things and specifics I can't necessarily get into, and certain things that would be inappropriate for me to. But the reason I do the meetings is to get information, some of it to drive our own macro view, and some of it to be able to share with clients where it is appropriate, where I have permission. And I think that, look, my comments on Secretary Bahnsen are that I consider him, I hold him in very high regard. And I don't necessarily agree with everything he has said publicly over the last few weeks, but I don't envy the position that he's in. And I'm respectful of the fact that there is an agenda a Treasury Secretary ought to have, there is leadership he has to exert, and there is a deference to his boss, all the while attempting to move the policy framework in the direction you believe is best, and yet also serving at the pleasure of the president's agenda. And if we get to a point where the president and his agenda are not something you can be comfortable with, then it's your job to consider stepping away. But I believe that Secretary Bahnsen is trying to thread a needle. Okay, that's my own view. And I have reasons I believe that. And I don't think I could do it. I don't believe that I possess the diplomacy or tact, or some could say gamesmanship, necessary to kind of do both these things at once. And also, I think too that my own views on some of these things and my views as I would articulate them, if I worked for President Trump, would likely mean I wouldn't be welcomed in that position, and that's okay. But my point being, I respect the secretary and definitely detect his respect for his boss and that agenda, but all the while see a lot of this in the context of a tightrope he's walking. And so I want to share a couple of my takeaways. And I will probably end up needing to write more in the Dividend Cafe this Friday because there's a lot more to be said. And I expect more coming out here this week. Um, Here's my first takeaway I'm going to share. I'm going to do these as quickly as I can. Number one, I don't think there's clarity in markets, in the media, in the public about tariff policy and what is coming in tariff policy on April 2nd, because I do not believe that there's clarity in the administration around tariff policy or clarity in the administration about what they're going to do April 2nd. And that was very abundant to me in my conversations last week. Number two, I do believe that they're doing a good job keeping this out of the public eye, but I think there is a bit of dissent or conflict between the Commerce Department and the Treasury Department. I don't think it's out of control. I think there's a functional working relationship, but I think the optics, communications, and to some degree, the ideological approach is different. And you could argue there's some of the NEC, National Economic Council, Treasury Department, and then the Commerce Department, where Secretary Howard Lutnick and U.S. Trade Representative Jameson Greer reside. And I don't think that's fully understood in the public eye, that this conflict exists. I feel comfortable sharing that that's my view. And yet I don't have a perspective on how it all gets settled and how it gets reconciled or resolved, if it gets reconciled and resolved. But I will say that the Commerce Department is driving the specifics of April 2nd. And so if those particular trade deals and policies are under the portfolio of commerce and not Treasury, I would view that with a negative bias. Okay. Number three, the secretary has a far bigger priority on making permanent the 2017 Trump tax cuts, the TCJA bill, than I previously believed or understood. I came away last week very impressed with the intensity they have for prioritizing it, and the recognition, as I've written about time and time again in Dividend Cafe, of how difficult it's going to be legislatively, reconciling it to a difficult budget process and maintaining both House majority support and Senate majority support. Um, I do not know that they'll be successful. I do not know that they will fail. I know it is complex and challenging, but I do not doubt the intensity and focus that particularly Secretary Bahnsen has here. And whether or not this can get done in a timely manner, I'm more optimistic than I've been that they will get this done. I do not believe getting it done in November and getting it done in April or May are the same thing. So if it does fall to later in the year, that there's going to be some issues there, as I've talked about. But that was probably the most encouraging part of my meetings, is the laser focus that the secretary has on extending the Trump tax cuts. If I were a betting man, I would say the following two things about where we go from here. This is my fourth and final point. Subpoint A to point 4. The biggest thing I can see and where all this is going is that on April 3rd, I don't think there will be a lot more clarity than where we were on April 1. I think where we're going is a place of high presidential discretion. What sectors, what companies, what rates, what countries, what tariffs, on again, off again. There's a certain chaos, putting it more pejoratively, a certain discretion, putting it more diplomatically, that I think is going to be the likely outcome. And I don't think that's necessarily the same as clarity and policy cohesion. Number two, I do not believe that markets have moved enough yet to alter the president's approach to this, but I do believe there's a point at which markets could move enough that the president would move, because the president moving does not require a mea culpa, does not require an admission of wrongdoing. It simply requires an off ramp. And he may be one of the best I've ever seen at finding an off ramp, finding a way to claim victory. So let's just say that market alteration is 20%, and we're now less than 10% in terms of that correction. It may very well be that regardless of what pivot takes place, a recession could happen. Even if the president pivots, even if he finds an off ramp, a 20% bear market could lead to a self-fulfilling prophecy. So I do not believe that the president is willing to let the bottom fall out of the market. I do believe that there's a point at which he would pivot. I also do not believe that that point has been reached yet. So reciprocity, cheating, these are things I'm going to cover in the Friday Dividend Cafe. What does it mean that we're looking for reciprocal tariffs? Fairness, let's just try to unpack where things stand, and I'll share my view more on some of this on Friday in the Dividend Cafe. Until the announcements, let's say the last 28 hours of more targeted tariffs in the mix, and again, no one has the exact working document that Secretary Lutnick is working off of. Strategic Research was estimating that the cost of the tariff set to go into effect April 2nd would be $233 billion, which is 0.7% of GDP. However, that very surely came down in the last 24 hours based on some of the backtracking administration has done. All right, there's a lot that you can look at dividendcafe.com. There's a little more elaboration on some of these bullets there. I do think the theme of financial deregulation that we've had all year continues to be a big one. I think that there is more coordination going on between the Fed and Treasury and other regulators to create a less adversarial regulatory apparatus. Deregulation is a tailwind for the sector, but also for M&A. And I think financial transactions dropped 40% in the Biden administration, largely on an increased regulatory apparatus. I believe that the secretary's call for more coordination around and just a more collaborative approach to regulation indicates that this is still an agenda for the administration. Finally, you have to understand on the tax reform piece how important this thing called policy baseline is. Right now, some of the key stakeholders in this process are meeting with the Senate parliamentarian to get a feel for what is going to be on the table in the budget reconciliation process. What does it mean if you assume the current policy, okay, where these Trump tax cuts, the taxes have not come back, and so that's the policy baseline from which you're doing additional tax work and budget work. That is a much more benign outcome in terms of your suggested deficit impact than if you assume all of the Trump tax cuts come back and then you take them back again. That's trillions of dollars that you have to factor into the way the reconciliation process would work. It's a big unknown how this will play out. But from and I know this gets a little wonky, but from a parliamentarian standpoint, that specific factor is maybe one of the biggest factors we face in what the bandwidth for future tax cuts and tax reform is going to be this year. I have a chart at Dividend Cafe showing how inflation expectations had been very high for Republicans and had been much lower for Democrats. And then since the new administration came in, Republicans' forward inflation expectations have collapsed and Democrats' inflation expectations have gone higher. There's a very teeny tiny part of this that is somewhat rational on the way people in their own partisan hats might expect tariffs to be an impact, but the vast majority of it is probably not tariff analytics as much as just rank partisanship, both before and after. And I find it all embarrassing. So we know the Fed last week announced that the quantitative tightening of their balance sheet was going from 25 billion a month in treasuries down to 5 billion. I predicted it goes away altogether this year, and I think holding on to 5 billion a month on a almost $7 trillion balance sheet is a way for the Fed to just keep me from being perfectly correct in that forecast. I'm just almost perfectly correct so far, but in the meantime, their mortgage-backed securities that were being reduced via roll-off, they say they're keeping that 35 billion a month cap, but they've only been rolling off about 15 billion a month or so. So look, they have 2.7 trillion of mortgage-backed securities on their balance sheet. Had they been rolling off the full amount of their cap since quantitative tightening began, it'd be down to 1.6 trillion. So they've only reduced 500 billion, but they would have reduced 1.5 trillion. So the difference between what market conditions are letting the Fed tighten and what is actually their intent in tightening or stated intent are very, very different. Right now, we're at a 72% probability for a rate cut in June. We're at a 55% probability of 3 rate cuts by December, but we're at an 85% probability of 2 rate cuts by December. So we're still in a 2 to 3, much less so 3 to 4 now. So that has moved again in terms of rate expectations. All right, oil up 1.4% today. Note that the S&P was up 0.5% last week, but midstream energy was up 2.5%. The spread between midstream energy and the S&P coming into today was 10% on the year. And then we've added to dividendcafe.com Monday a glossary where I'm going to start trying to use every Monday to add one investment term, one expression, phrase, word that I use a lot that I might take for granted. People know what it is, and I'm going to try to define it. Today it is roll-off, which is this word for when the Fed is tightening. What it means is they have bonds that they're letting mature. When they just want to keep the liquidity the same in the financial system, they reinvest it. A bond matures, they get cash, they immediately turn around and buy another bond. Fed's balance sheet hasn't moved, the cash at bank reserves hasn't moved. Roll off means they let the bond mature, Fed gets cash, the banking system has less cash, the Fed's balance sheet goes down. Now, the roll off is a passive way of tightening. If you want more unpacking of what tightening and easing and all that means, that's fine. But I wanted to explain what the term roll off means to get there. So hope that's helpful. All right, there's a wonderful question in Ask TBG about tariffs. And so at dividendcafe.com, you can see the question. And then finally, I just want to read, I got an awful lot of feedback on the Friday Dividend Cafe, and one who is a friend of mine and became a friend and someone I knew. We traded a lot of information together back during the COVID days. Um, had emailed, and I wanted to read you what he had said. Both COVID and the financial crisis were extended periods of learning about the mechanics of how the world really works by watching what happens when it stops working. And his follow up note, I wouldn't wish for a similar situation, but I have to admit they were among the most dense periods of learning for me. And I think this is a really important thing. And it tags on a little bit to what I said on Friday in the Dividend Cafe. Two of the most difficult experiences in my life, the financial crisis and COVID, were absolutely two of the most educational and informative. And there's always a bright side. So I hope that that is interesting for you to reflect on. Appreciate my friend sharing it with me. I'm going to leave it there. Thank you, as always, for listening, watching, and reading the Dividend Cafe on this rainy Monday. I look forward to being with you throughout the week. And I will be in New York all week until I head back to California. At the very end of the week, I'll be in our Newport Beach office for almost 2 weeks starting this coming Friday. Thanks again. And thank you for being a part of the Dividend Cafe.